Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, September 7th, 2020, and I am pre-recording this Trading Places Live for Tuesday, September 8th. Futures are currently mixed. We're seeing a little bit of strength on the Dow Jones and relative weakness on the NASDAQ, which is exactly what we saw as we closed out last week. We'll see whether or not that continues in the morning when the market opens, but at least futures are pointing in that direction. Let's go through the agenda. I'm going to go through that daily market recap with you from Friday. Then we'll get into talking technically. I want to talk a little bit about the warnings. I wrote about them in my Chart Watchers article and then in Trading Places Live last week. So I want to go just go back and rehash that, go through some of the things I was seeing, and then we'll look at some of the 60-minute charts and some things I think we need to look at to see how the market may recover out of this. We'll go through all that during talking technically. Then I'm going to go through the scooter report. Sometimes the scooters, we see big changes, and you might not know why when you look at the chart. I'll explain some of that when I get into the scooter report. Then we'll get into the earnings spotlight and wrap up the show with the 3 you must see. But before we get into the daily market recap, let me just go over to earningsbeats.com. I want to point out that we do have a free Earnings Beats Digest newsletter. It is published Mondays, Wednesdays, and Fridays in the morning, typically before the market opens. All you need to do, type in your name, email address, hit that subscribe button, and you can join our community of thousands of traders. If you want to unsubscribe, you can do that at any time. There's no credit card required, so very simple. If you'd like to try our service, and you can check out our portfolios, how they've been performing over time since their inceptions. I think the portfolio performance speaks for itself. Obviously, there is volatility from week to week, but overall, I think the performance is pretty strong. If you click on the Join Today button, it will take you to a form where you can see a little bit of what you get. I do want to point out that trial members, you get 30 days, and effectively it's a zero charge. You get charged $7, but then we refund you the $7 within about a week. So there's a net cost of zero for 30 days. So I think you might enjoy the service. Check it out. That is a no-cost trial. All right, let's move on and start with the daily market recap from Friday. It was a wild end to the week last week. We saw the market really getting hit hard during the day on Friday. We did recover. It looked like all the major indices might go green and stay green, and then we saw a little bit of selling into the close again. I'll talk during talking technically about the 60-minute charts because I think that's going to be the first clue, something we need to really watch for. But just looking at the daily charts, I mean, we've been going up for quite a while. And this pullback and some sideways consolidation and some basing would not be a bad thing for the market. When you've seen a move that just continuously goes up day after day, week after week, like we've been seeing since that March low, especially if you look at this NASDAQ chart, we really haven't seen much below that 20-day moving average. We did come down and test the 50-day moving average on Friday, and I would not be surprised to see the market continue to consolidate sideways, possibly even go lower again. We are in the month of September where we do typically see historical weakness in the market. This is the 1 month of the year where the S&P 500 has actually gone lower more often than it's gone higher since 1950. It's the only calendar month that's done that. So we are in a historically rough period that we certainly need to keep an eye on. But mid caps down, small caps down, really across the board. But the NASDAQ did take the brunt of the selling on Friday, as it did on Thursday. So it was a rough end to the week. You can see the NASDAQ, which was over 12,000 on Wednesday of last week, went below 11,000 by Friday. So you're talking about more than 1,000 points down on the NASDAQ in just a couple of days. So it was a pretty rough couple of days there, but it has bounced back pretty nicely. The sectors, looking at the sectors, we saw a little bit of weakness. Actually, I got a couple of these. I don't know why it's they're coming up like that, but I guess I made a mistake in here. But I did want to point out industrials had a pretty nice day on Friday. We saw materials doing pretty well. Actually, financials did well as well. Doesn't show up here on this chart, but they did well. Communication services struggled. Technology definitely took a big hit on Friday as well. Big percentage drop, 1.39%. Moving on to the 10-year Treasury yield, big move up in the yields on Friday. 10-year Treasury yield was up just about 10 basis points. So from 0.62% to 0.72%. I was a little concerned watching last week as the yield continued moving lower and lower. Tried to move and actually did move temporarily below the lows that we saw in the middle part of the month, in middle part of August, that is. But we did rebound back. And if we can get a close back above 0.75, I think that would be bullish for equities in the U.S. It may lead to more money rotating into the Dow and the S&P versus the NASDAQ, but that's okay. In a bull market, we want to see wide participation, even if it means the value stocks lead for a period of time. From a longer term perspective, that's exactly what we want. We want to see all areas of the market participating in this advance. So let's watch for that. Let's see if we get that breakout in the 10-year Treasury yield, and if so, let's see if the value stocks lead again to begin this week. No economic reports are due out on Tuesday, nothing of significance. So I'm not really expecting any major moves in the bond market because of economic reports. It's really just going to be traders and seeing whether or not technically they want to move out of the bond market and move into equities. That will be certainly something to watch as we open up the week. All right, let's move into talking technically. And the first thing I wanted to do is I want to go through and show you a couple of the articles that I wrote. One in the Chart Watchers. This was back on August 28th. And I talked about this key sentiment indicator flashing a major short-term warning. And if we go down and we take a look, it's the volatility index. And this is a chart. It's an invisible chart with a 5-day simple moving average. Well, let me pull up the chart and I'll show you how you can set this up. So down here in the bottom, the type of chart, see right there, invisible. So what that means is if I don't have an overlay, there would be nothing on the chart. You wouldn't see anything. But I have a 5-day overlay, 5-day simple moving average overlay. So it's just like the 50-day moving average, except it's only a 5-day. And that's what you see here. That's this blue line right here. 5-day moving average, 2869. You can see it up here now, 2869. So that's all this is just a 5-day moving average of the VIX. Now, we started turning back up again. We're at a high from the last couple of months, 5-day moving average, so the market's getting a little bit more nervous. But the point that I was making in the article was the S&P 500 was also moving up while we were seeing the VIX move up. And that's not the typical correlation. Normally we have inverse correlation. Usually here, look at this huge move up in the VIX, well, the 5-day moving average of the VIX, and look at the S&P dropping. And then when the S&P was rallying, we see the drop in the VIX. So it's normally an inverse correlation. Well, the warning sign that I was pointing out was right here, and I'm going to actually go back into the article for a second, because when I wrote this, the correlation was not quite positive. Actually, that day on Friday, intraday, it went positive, but by the close, it had gone just a little bit below the center line. All right, so we were starting to see more positive correlation as we were moving toward the zero line, but when we move on over here to the actual, to see where we are now, look at where we got up to, 0.75. That was the highest reading we had seen in the last 5 years. And the reason this is significant is that anytime you see volatility rising when the S&P 500 is also rising, it's telling us that the market is growing more and more nervous, even though prices are going up. And so if anything comes up to spook the market, a lot of times we can see a big sell-off. And if you look back to periods where we have seen this correlation turn positive, you can see the last time that we had seen it turn positive was back at the beginning of 2020. And it didn't coincide perfectly with a top, but we did have a short pullback, went up one more time, and then took a big hit. If we go back the time before, which was back at the beginning of May of 2019, we went positive. Look at where the S&P 500 is, and look what happened over the next 30 days. Went straight down. We lost probably about 7-8%, something like that, in a pretty short period of time. And then if we go back again to the most most recent one prior to that, you can see that was back at the beginning of 2018, January, maybe early February 2018, and we were up near this 0.75. And look at the big drop. It did mean that we were starting a bear market. I mean, we went through a lot of volatility. This didn't mean that we're going to have a bear market. That's not what this means over here. It just means that the market is growing more fearful as prices rise. And so if you get any kind of bad news or any kind of profit taking that begins, sometimes it can really escalate quickly. And that's what we saw last week. So it's really important to watch these signals. Now, I also wrote an article in Trading Places, my regular blog. I write in here usually once or twice a week. And you can see I had an article here from September 3rd of last week, posting 2 indicators that were telling me to be extremely cautious. And the first was the positive correlation between the VIX. So I went ahead and pointed that out again for those maybe who hadn't read the chart watchers. And you can see at that point, it was up at that 0.75 level. And then the other one down here was the put call ratio. And the equity put call ratio was down at a 5-year low. And you can see the last time we did that back at the beginning of June, where we got down here to 0.4. Look at the steep drop that took place. So everyone's buying calls. Well, market makers are on the other side of that. So if everybody's buying calls, market makers are selling calls, which essentially means they're shorting. And if they're shorting, they usually make money. Market normally pulls back. So anytime you see the extreme readings or unusual readings in these sentiment indicators, you want to pay attention to it, because many times the signals that these sentiment indicators give us precede what actually happens. So it's not the sentiment indicators telling us after the fact. These sentiment indicators, I was writing about this before the market took its hit. So you've got to pay attention to sentiment. And when the market gets to certain levels, when these sentiment readings get to certain levels, you have to begin to at least be more cautious. They don't guarantee us anything. But what I use and what I always say about technical analysis is that it's what I use to help me manage risk. It's not designed to help provide guarantees. A lot of folks who don't like technical analysis or don't believe in technical analysis will always point to things that don't work. And they'll say, well, this line crossed this line. That means this is supposed to happen. And it didn't happen. So therefore, technical analysis doesn't work. Well, that's hogwash to me. For me, it's all about managing risk. It's not about being perfect. It's not about being, providing a guarantee. When you start seeing sentiment turn like this, where the VIX is rising with the market and everybody's jumping in, the market's getting nervous. And while the market's getting nervous, everyone is buying calls. That's not a good combination. And so that combination resulted in what we saw last week, which was selling. So I'd been talking to Earnings Beats members last week, pointed out that I was building cash. That's the way I normally deal in a bull market when things start to look a little bit toppy in the near term. I remain extremely bullish. I think the long term, we're going a lot higher. But if you're a short-term trader, going a lot higher in 6 months, 12 months, 18 months doesn't matter much when you've got all your assets at risk and the market takes a big hit. That's losing money as a trader. I mean, you're losing a lot of money. So I think it's best when you start to see these sentiment indicators provide the readings that they were providing. I think it's best to take some things off the table and begin to reduce risk. Or I mean, those who are really aggressive could short the market. I had members write to me and say they had shorted, or that they were maybe buying the UVXY, which is the ultra VIX, basically. As the VIX rises, it's just they're playing the rise in the VIX on an ultra basis. So trying to look for the right word, leveraged. So it's just that they're leveraging. You could buy S&P puts to protect a portfolio. There's lots of things you can do to manage risk that in a full-fledged advance, I wouldn't worry. I wouldn't put my money to work in that fashion, because I feel like I would just be burning, just burning my money up. Instead, I want to have those sentiment readings telling me that I need to be more cautious. And at that point, for me, what I tend to do is just build cash. And then if the market pulls back, starts to sell off, I start building positions again. Okay, so let's take a look at the 60-minute charts. Because when I start seeing selling, first of all, when you're in an uptrend, the hourly PPO tends to stay above the center line. We went a little bit below here back around August 20th, 21st. And that's the rough time of the calendar month as well. But when things start to turn more bearish in the near term, what you see is a big drop below the center line on the hourly PPO, which we saw. And as soon as we went below, I want you to look at these two bounces. The first bounce, we failed at the 20-hour EMA, went to a new low, came back up. Where did we fail? We had this big rally on Friday, almost turned positive. Actually, we did turn positive on the Dow, but couldn't get through that 20-hour EMA, and we fell back into the close. So we're looking at futures maybe being up a couple hundred. That could, we finished at 28,133. If we go up 20 or 200, that would be 28,333. And our 20 hours sitting at 28,330. So it looks like, based on futures, maybe we're going to gap up and test that 20-hour EMA again. We'll see what happens from there. But the Dow is just one of the indices. Let's go right through all of them. The S&P 500. We didn't even get back to the 20 on this first initial bounce, and didn't quite get there on Friday before we turned back down into the close. Look at the volume pickup on the selling into the close. The NASDAQ 100. Same thing, selling, came back up, couldn't quite get to that 20-hour, and then we were weak into the close on increasing volume. How about just the NASDAQ? Not just the NASDAQ 100, but the NASDAQ composite. You can see down, came back up, close to the 20-hour, rolled back over. Small caps. Starting to see the theme here. Same thing here, and then on mid caps. Same thing, move down, test the 20, move down again, come up, get close to the 20, and then roll over into the close. So the first thing we have to do to even begin to right the ship is we need to get back through the 20-hour. I think a lot of folks looked at that rally on Friday and said, oh, that was it. That's all the selling. I'm not so sure. Not that I wouldn't be buying. In fact, I did buy some things on Friday, begin building some positions, mostly in portfolio stocks that we have at earnings beats. So those, in my opinion, are some of the best performing stocks. And as a result, when we get selling like we saw last week, I tend to start picking some of those stocks up. But that doesn't mean that we're not going to go lower. I don't know exactly how low we're going to go or how low we could go. I mean, if I pull up the NASDAQ 100 and we go back a few months, to try to maybe look, I mean, I wouldn't be surprised to see like an ABC type correction with the C coming back down, maybe to this low, maybe even all the way to this low. This would be pretty important because we had a top here, we broke out, we come down on a couple of different occasions, test this gap support and price support. I mean, I think probably 10,300 would be about the most I would expect. And we got down to 11,1 and change on Friday. So I wouldn't be surprised if we take that low out to maybe make a run down there for those lows. But, maybe watch first for this initial gap and price support around 10,850, 10,875. If that one doesn't hold, then I'd be looking more down toward these lows that we saw back in July. And basing for a period of time, I think would be very healthy for the market. We've had a straight move up. I mean, the NASDAQ, we were at 10,400 6 weeks ago, and we went up to 12,400. That's 20% in 6 weeks. 20% is a good return for 2 years. We did it in 6 weeks. So I wouldn't, fret too much about a period of selling. When you go straight up, the market many times will go straight back down for a period of time. I mean, usually it's scary. I would much rather go up, sideways consolidate for a period of time, then go up, sideways consolidate, get that basing. To me, that's a much healthier advance. When you just go straight up like this, that's what leads many times to that huge selling and the panic that we saw on Thursday and Friday. I refer to it as market makers going on vacation, kind of like a matador. Their job, market makers' job, there is to provide liquidity. So when people start selling, market makers buy. But if you start seeing the volume pick up like this, then a lot of times I think market makers just kind of move out of the way, and it allows the market to sell off significantly in a very short period of time. I mean, if we look at a stock like Apple, which is obviously a major contributor to the NASDAQ 100, stock was up to about 138 on Thursday. And by Friday's low, or maybe that was Wednesday, but anyway, by Friday's low, we were down to 111. 138 to 111 on Apple. $27. 20% of the stock value gone in a matter of 48 hours or less. How about Tesla? We were up over 500, went down to 370. It was a 25% haircut in 2 or 3 days. So, and Apple and Tesla, in my opinion, kind of got things started in terms of their selling. I mean, if I pull up Tesla, and let me put in here, I'm just going to put the QQQ and I'm going to put it behind price. And I'll do pink so it really sticks out here. But if you notice, the QQQ kept going up for another day. Do you see Tesla go down here? And if Apple, let me pull this one up, you should see the same thing. See, Apple topped and was started to sell off. So you had two of the best performing stocks in the market begin to sell off the day before the overall market did. There was already, and I just referred to it as cracks in the foundation. When we started seeing Apple selling off on big volume, Tesla selling off on big volume, and look at Apple. Apple could not rally. Even when the QQQ went to a new high, Apple was not rallying and right back down again. And if we take a look at Tesla, here was the move down. Look at the rally on the QQQ. Do we have much of a rally here? Nope, not even close to where we were before. When those two stocks didn't rally, it was just everything started selling. So that was definitely a little bit of a warning sign. All right, let's move on to the scooter report. And I wanted to show you a couple things here with the scooter report. First thing, I'm in the small cap. I'm going to move it over to the mid cap and take a look. It's a 1 week period. So what this is doing, I've got it sorted in the scooter change order. Normally what you'll see is it's in scooter order, all right, which is from 99.9 all the way down. I moved this to the change. I wanted to see what was changing. And so Corcept Therapeutics is the one that moved the most last week. Went up 82.7 on its scooter. So it went from 15.1 to 97.8. And so that probably required quite a move to the upside. And so if I pull the chart up, you can see we were down 12 and change, went all the way up to 23 and change. So definitely that's why you saw, there's your accumulation distribution. I don't have the scooter on here, but that's why you saw the scooter make such a big move to the upside. It had to do with the the huge move in price action. So that'll certainly take the scooter score up. But I wanted to show you a couple of others. How about SSL? Yeah, look at this one. Okay, so if we go back to the scooter report, you can see this stock showed its scooter going up 74 up to 84. So it went from 10 to 84. So when I look at that, I would say, okay, it's probably made this big move to the upside, right? But when I pull it up, it didn't really do anything. So what's up with that? Why would a stock have a scooter jump so much when the stock did nothing for, most of the last week? Well, you have to understand how the scooter is calculated. And I'm going to have to go through this kind of quickly, but if you go into chart school, it'll show you. But here are your weightings, long-term weightings. Do you see this 125-day rate of change is 30% of the calculation? The 20-day rate of change is 15% of the calculation. So if I take this and I just swap this out, so let's get rid of this. Let's go to the rate of change here, and let's do the rate of change again. So 125 rate of change and then 20 rate of change. And I'm just going to make these a little bit bigger so that we can see them really well. But this is, 45% of the calculation. Now, the 20-day didn't really change because we haven't done much in the last 20 days. But look at the rate of change skyrocket last week on the 125-day rate of change. Now, you look at it, it's not because it went up here. It's because a week ago, we were comparing $7.50 versus $10. And so the 125-day rate of change was minus 25%, 30%. But once we moved out in time, when you look back 125 days, now you're looking back at these days. And so all of a sudden, the rate of change went up a lot. And so now we're 80% higher than where we were 125 days ago. That's the reason why the ROC, rate of change, jumps like this. And that's why we're also calculating so much stronger on the scooter with that kind of a jump in the rate of change. So it's not always what you're doing now. It's what you're doing now relative to what you were doing 6 months ago. That's what you have to focus on. All right, earnings spotlight, just a couple of things. I just wanted to point out Lululemon, Coupa Software, Slack, which is work, WRK, all report on Tuesday. So you want to keep an eye out on those. Later in the week, we got a couple good ones with Chewy, CHWI, and Peloton, PTON, both reporting on Thursday. All right, let's wrap this thing up with the three you must see. I'm going to start off with Tilly's. And Tilly's on a relative basis, actually just on an absolute basis, you can see the breakout. Look at the volume pickup on Friday, making this breakout above the June high. Very positive development, and the accumulation distribution really starting to soar. So I really like what's taking place here. DQ, now this is one that's been pulling back, but it did print a hammer on Friday right at about this breakout level after nearly testing this gap support. I think it could go down to the upper 80s, but this was a $135 stock just about a week and a half ago. So this one's getting pretty interesting. And then the last one I wanted to mention is CAL, another one that's making this move up. Look, all of a sudden, accumulation distribution building, volume picking up. I think Caloris, I'm not sure if I'm pronouncing it correctly, but this one looks pretty good. Still need to get that breakout above 11. All right, that's it. I want to wrap up now and wish everybody good luck on Tuesday. Hopefully the market will start to recover sooner rather than later. Everybody have a great day. I'll be back on Wednesday over at earningsbeats.com. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.